So Nicole, picture this. You're a CFO preparing for your quarterly earnings call, and an analyst calls you up and says, hey, can you break down how much your cost of goods sold is actually labor costs versus materials versus depreciation?
Right? And you're probably thinking, well, we present cost of sales as one line item, but you know what? That's about to change in a pretty significant way. The FASB just issued new guidance that's going to fundamentally change how public companies communicate about their cost structure. And this isn't just about adding a few lines to your footnotes. We're talking about potential system changes, process redesign, and new controls. Companies that wait until the last minute are going to find themselves scrambling.
And this is exactly the topic we want to tackle right now. And even though the effective date of this new standard is a couple years off, the implementation effort we can recognize is going to be real for impacted companies. And they really need to start planning ahead to get ahead of the standard. And that's what we're here to talk about, the new DISE standard and what companies need to know.
Welcome to Accounting Matters, where we break down complex accounting standards into practical insights you can actually use. I'm Nicole Harger, Senior Managing Director here at Embark.
And I'm Adam Olsen, Embark's National Head of Practices. And today we're kicking off our three-part series on one of the most significant new standards that we've seen in recent times coming to financial reporting. DISE, or the Disaggregation of Income Statement Expenses, also known as ASU 2024-03, which was issued by the FASB back in November of 2024.
And so here's how we're going to break down the series. Today, we're covering the foundation, so the why behind this standard, who it applies to, and when it takes effect. And then we'll also dig into what makes an expense caption relevant under this guidance. Episode 2 will be a deep dive into the 5 required natural expense categories: purchases of inventory, employee compensation, depreciation, intangible amortization, and DD&A. We'll cover what's included, what's not, and highlight some of the tricky areas. And then episode 3 will wrap up with practical implementation. So systems, processes, common challenges, and best practices. So Adam, let's dive in.
Awesome. So Nicole, let's start with the fundamental question that a lot of people may be asking, like, why this standard? Why did the FASB issue this new standard? What problems were they trying to solve? And I think the answer here really goes back to a long-standing request that was coming from the investor community, where a lot of new standards originate from. And so for years, and I mean years, investors have been asking for more detailed information about the nature of expenses in financial statements. You know, if you look at a typical income statement today, expenses are organized by function, right? You've got cost of goods sold, you've got SG&A, maybe R&D on the income statement, but those functional categories don't tell you much about what types of costs are actually included in those line items. And so this creates real problems when it comes to comparability for investors and for analysts. And if an investor is looking at, you can take 2 manufacturing companies, for example, then both of them show cost of goods sold on the income statement, right? An investor stepping back might be like, I really have no idea how much of that cost of goods sold line item is comprised of labor, how much of it relates to materials, how much of it is depreciation, right? So one company could be highly automated and they've got lower labor costs and higher depreciation. And then you could have another company that's actually more labor intensive. So the labor component of that line item is much more significant. And so without a natural expense detail, you're really kind of flying blind when you're trying to analyze, operating leverage ratios or understanding how maybe a certain cost structure might respond to volume changes, or if there's a highly labor-intensive company, how wage inflation may impact that line item or commodity price movements, et cetera.
Yeah, and this has been on the FASB's radar for a long time, right? Mm-hmm. So it's actually part of a broader disclosure effectiveness initiative that they've had going on. If you've been following the FASB's work over the last few years, you've seen this theme emerge. So they issued ASU 2023-07 on segment reporting, which requires more disaggregated expense information at the segment level. And then you have ASU 2023-09 on income tax disclosure, which requires more detailed rate reconciliation information. So DISE is really the third installment in what they've been calling their expense transparency trilogy. I love that they're calling it a trilogy. It sounds very dramatic, but there is a consistent theme here. So the FASB has been listening to investors say, we need more granular expense information, and they've been responding with these targeted disclosure improvements.
Yeah, and it's not just a US phenomenon, right? We're hearing about too when it comes to more transparency, right? So the IASB also just recently issued IFRS 18, which kind of has similar requirements for disaggregating expenses by nature. And right, this is just part of that global movement, like I said, about wanting to understand more detailed information right now. And if you really kind of look at we're not going to spend a ton of time breaking this down, but just high level looking at IFRS 18 versus kind of the new FASB DISE standard ASU 2024-03 side by side, they are pretty aligned in terms of like what they're trying to achieve. There are some slight differences here about some of the presentation requirements for the income statement that come out of IFRS 18. That standard actually goes a little bit further than how the FASB took the US GAAP standard, but the underlying objective, like I said, is pretty much the same. They really want to respond to the same investor feedback both domestic and international investors and analysts are having around just having better visibility into cost structures overall.
Yep. So what does this standard actually do at its core? So at a high level, public business entities are going to have to provide a tabular disclosure in the footnotes that disaggregates certain income statement expense captions into natural expense categories. And by natural expense categories, we mean categories based on the nature or type of expense, like employee compensation, depreciation, purchases of inventory, as opposed to functional categories like cost of sales or SG&A. So you're basically taking those functional line items on the income statement and breaking them down by the underlying nature of the cost. And here's kind of the critical distinction. This is a disclosure requirement, not a presentation requirement. So the FASB was very clear about this. They are not changing what goes on the face of the income statement. Companies can continue to present expenses how they currently do, whether that's by function, by nature, or some hybrid approach.
Yeah, and the SEC actually kind of doubled down and confirmed this too, because this was a question I think a lot of preparers were having, and they did confirm that DISE requirements also don't change any of the guidance in Regulation SX Rule 503. So when it comes to what you present on the income statement under SEC reporting rules, that'll remain the same. You will continue to follow the same presentation rules. But what the standard really is about is enhancing footnote disclosures, right? It's about providing more information, like we've said kind of from the start of this podcast, about what's inside the income statement and inside those specific line items. And that brings us to, I think, our most important concept in the standard, which is the idea of what is a relevant expense caption, because this really helps set the foundation of kind of everything that follows.
Yep. So before we go further into relevant expense captions, let's talk about scope. Who does this standard apply to? Because not every company is going to have to be subject to these requirements. The standard applies to all public business entities, so PBEs, using the ASC Mastery Glossary definition. And that's broader than just SEC registrants, which I think surprises some people. It includes broker-dealers, entities with securities trading on an over-the-counter market, and entities preparing for an IPO.
Yeah, and it also includes entities whose financial statements are included in another entity's SEC filing. So, common scenarios that always come up are, right, entities that are subject to kind of Rule 305 filings, so for acquired businesses, Rule 309 filings, so significant equity method investees, financial statements that may be included in proxy statements, or, if you happen to be a participant in a SPAC transaction, those are other circumstances where this standard could apply as well. It's also important if you're a private company to kind of keep in mind that if you get acquired by a public company, your financial statements also need to be filed with the SEC. And so in those circumstances, you would also be subject to the DISE requirements for your financial statements. So one thing to keep in mind, private companies is there's a number of kind of paths forward where you may be pulled into the DISE standard, like the one I just mentioned. But also if you're just thinking about becoming a public company down the road, it's just something you need to keep on your radar as you prepare for public company readiness. So even though you're technically out of scope today, like I said, it's just something you don't want to be caught flat-footed about being a requirement down the road if any of those are on the horizon.
Yep. And on the flip side, this does not apply to private companies that are staying private, or not-for-profit entities, or employee benefit plans in the scope of ASC 960 962, or 965. So if you're a private company with no plans to go public or be acquired, you can breathe easy, at least for now. Although the Private Company Council may take the step at some point to consider whether private companies should have a similar requirement. But as of today, it's PBEs only. So now let's talk about timing, because the effective dates truly are critical for planning. So Adam, walk us through when the standard kicks in.
Yeah, and I know we'll get more into implementation, timeline, and planning in our last installment of this series, but just walking through the effective dates of when this kicks in. So the standard is effective for PDEs, as we mentioned, for fiscal years beginning after December 15th, 2026, and for interim periods within fiscal years, the subsequent years, so beginning after December 15th of 2027. So in more simple terms, what does that mean for a calendar year in company is the first disclosure would be in your 2027 annual financial statements, and then your interim disclosures would start in 2028. So still a little ways off from the timing of recording this podcast, but like we'll talk about in upcoming episodes here, the lift on implementation could be pretty significant for some entities. So getting ahead is best recommendations here. As far as early adoption, that is on the table if you were to choose it. So permitted for early adoption here, though we expect most companies will most likely align with the effective dates, just given the amount of work that's involved here. And then from a transition perspective, there's a few options here. So just starting with the first one. So there is a prospective adoption option, which means that you would obviously apply the DISE standard to reporting periods after the effective date. You wouldn't restate your prior periods. So what does that mean? Obviously, in year one is that you just will not have comparative information as it relates to kind of the DISE disclosures. But as you move through, so you move into 2028, for example, you would then have comparative periods for 2027 and 2028, but your 2026 would not have the DISE information, and you can continue to build up to get to that comparative period year over year with each subsequent period. I think, the FASB did this because they obviously recognize a lot of the information that probably needs to be gathered to effectively be able to present on this will take quite a bit of effort and time. And so they didn't want to overburden companies. So perspective was clearly an avenue companies were afforded to take here to provide more time for that. And also just frankly, some companies may not even be able to gather all the historical information. So it's something they have to just start preparing for and building processes and controls going forward on. Yep.
And so one thing to note here, although companies do have the option to adopt retrospectively if they want to, right? So if you have the information and you want to provide comparative periods from day one, you most certainly can. I do think that's going to be a strategic decision for some companies. So there might be competitive or investor relations considerations around providing that information right away versus building up to it over time. Although I do think the reality is most companies are going to go the prospective route just because of the implementation work that's going to be required.
Yeah. All right. So let's talk about then kind of the core disclosure requirements at a very high level. Like, what do companies actually have to disclose? We've mentioned the 5 natural expense categories a few times in our conversation, which we'll drill into a bit more there a little bit later. But there's more than just those 5 kind of natural expense categories that have to be considered as you kind of build out these different tabular disclosures. So for each relevant expense caption, and I know we'll hit on that next, you have to present a tabular disclosure in the footnotes that's going to be made up of several components. So what goes into that tabular disclosure? Well, the first thing is those 5 required natural expense categories. So the purchases of inventory, the employee compensation, depreciation, intangible asset amortization, or DD&A if it applies to specific industry guidance there. And you only have to disclose categories that are actually present in that expense caption. So if your cost of goods sold, for example, doesn't have any intangible amortization, you obviously wouldn't have that as part of that component 1. But any of those 5 natural expenses that make up that relevant expense caption would need to be included in that tabular disclosure. In addition to those 5 kind of natural expense categories, there's also kind of a second component of the tabular disclosure, and this is about integrating other disclosures into this disclosure here. And this is where you separately present certain expenses, gains, or losses that are already required to be disclosed under other areas of GAAP in your financial statements that are relevant to these relevant expense captions, they would have to also be included. And the standard provides 2 lists to help kind of simplify how you need to think through maybe where these would exist in your financial statements. And so list 1, we'll talk through first. List 1 includes all of those items that are always required to be presented separately. And so if they are in a relevant expense caption, like I said, they need to be built into that tabular disclosure. And this includes things like impairment losses, exit or disposal costs, gains or losses on like derivatives. And like I said, these are things that you see throughout your financial statements that you are already disclosing the amounts, and you probably already have some like narrative language explaining like where that amount is reflected on your income statement. So these are a little bit more straightforward on how to pull these into the tabular disclosure for list 1.
Yep. And then on the second list, this one works a little bit differently. So this is items that are only required to be presented separately if they are included entirely in one relevant expense caption. So things like operating lease costs, warranty expense, amortization of contract costs under ASC 340-40. And so the logic there is really these items don't currently require disclosure of which income statement line they're in under existing GAAP. So the FASB only wants you to break them out in the DISE disclosure if they're all in one place. If they're spread across multiple relevant expense captions, they just get included in one of the other categories or in other items. So for example, if a warranty expense is recorded entirely in cost of goods sold, you break it out separately. But if warranty expense is split between cost of goods sold and SG&A, you wouldn't break it out. It would just be part of the other items in each caption.
Yeah, and speaking of other items, that is kind of the next key component of the tabular disclosure. So after you've disclosed all of those required natural expense categories, the 5 we listed, and then these other items that exist under other GAAP, the list 1, list 2 things, you likely might still have some portion of the balance that has not yet been disclosed. And this is generally falls into kind of that other items category, right? And so for the other items, you really just have to provide a qualitative description of what's in there. So based on the natural expense classifications, and this is, it's helpful, right? So you're not having to disaggregate every like nuanced little thing that potentially could roll up into a very large balance. But what you have to do is really just describe kind of what types of costs are included in that remaining bucket, right? Not describing every little thing if it's made up of hundreds of things, but maybe picking out some of the more significant items based on the nature of those items, like just provide some context for what's going into that other balance. And then there's a couple other like additional line items that I do want to highlight that might be relevant just depending on kind of your facts and circumstances here. So one is around expense reimbursements. So if you receive or pay any type of cost reimbursements under maybe like a cost sharing arrangement, those may need to be disclosed separately or handled in a specific way. So the standard speaks to that. And then there is one nuance here as it relates to kind of inventory. So the purchases of inventory, natural expense caption that we talked about. And we'll talk more about this in our next episode here. But if you use the cost incurred basis, that kind of changes the presentation of that tabular disclosure. And in that circumstance, there'll be some additional line items in there to represent changes in inventory, and then probably even other adjusting and reconciling line item for that inventory disclosure.
And so the key point here is really the tabular disclosure is meant to be a one-stop shop for users to understand what's driving your expense captions. And this does apply to both annual and interim periods with just a couple of exceptions. So you're providing this disclosure every quarter, which is important for planning because this isn't just an annual close process. You need systems and processes that can support producing this information quarterly. Now, before we move to relevant expense captions, we should talk about selling expenses because that's a separate disclosure requirement that sits outside of the disaggregation table. Companies have to separately disclose the total amount of their selling expenses every period, annual and interim. And what's interesting is selling expenses is not defined in the standard. So companies kind of have to come up with their own definition. The FASB did want to give companies flexibility because what constitutes as selling obviously can vary across different business models and industries. And so although you do have to disclose your definition annually, and if you change it, you have to recast your prior period. So there's accountability and consistency built in.
Yeah, and the FASB, I think they acknowledged this in their basis for conclusions on the standard, right? They wanted to make sure management had kind of broad latitude here. So that means management kind of has decision points that they have to make as it relates to thinking through their selling expenses and kind of what gets included or doesn't. So that could be things like whether to include or exclude fulfillment costs, costs of physical sales locations, maybe how you allocate certain management type expenses, advertising expenses, and other things and judgments that need to go into that. And the concept here is that the FASB recognizes that management's in the best position to understand their business and explain what should be there versus kind of like prescribing specifically this is what needs to go into that. And like you said, you just need to be then transparent about like, okay, management's view on this is that selling costs include A, B, C, D, and you explain that the nature of those costs to the users of the financials and make sure it's applied consistently.
Okay, let's dig deeper into the relevant expense captions because this is really the foundation of this standard, and this is the first step in applying the guidance. So figuring out which of your income statement line items need to be disaggregated. What is it? A relevant expense caption is an expense line item on your income statement within continuing operations that contains any of the 5 specified natural expense categories. So I'll go through those again. Purchases of inventory, employee compensation, depreciation, intangible asset amortization, or DD&A. So if an income statement line item contains any of those 5 categories, it's relevant and it needs to be disaggregated. So for most companies, I think the usual suspects are going to be relevant. So cost of goods sold almost certainly contains at least one of these categories. So typically purchases of inventory, employee compensation, and depreciation. SG&A probably has employee compensation and depreciation at a minimum. And then R&D typically has employee compensation, maybe depreciation on lab equipment, and possibly amortization of acquired technology. But things like interest expense or income tax expense likely won't contain any of these categories, so those wouldn't need to be disaggregated. It's really about what's actually in that line item, not what it's actually called.
Yeah, and the standard also does provide some specific exceptions that I think are worth understanding here. So the first exception is around equity method investments. So if you have a line item in your income statement for a share of earnings or losses from an equity method investee, that's explicitly not considered a relevant expense caption. And the FASB was intentional about this, right? They didn't want to have companies having to look through to the underlying investee and try to figure out what's in there and disaggregate that because, frankly, that's very challenging. It would create unnecessary burden and probably not even practical in reality here. So an extension of this is based on this exception. We also believe that there are other related items that also are likely not relevant. So any gains or losses on disposal of equity method investments or impairments of those, we believe by analogy, because of the exclusion of earnings or losses from equity method investees, that those would also be excluded from the disclosure. The next exception is what they consider kind of like the entirely in one category exception. So if an expense caption consists entirely of one required natural expense category, no further disaggregation is needed. And so, you can think about like if you've got a standalone depreciation line that's only depreciation, right? There's really nothing else to break down. It's already disaggregated, so there's no separate disclosure that's required for that. One thing companies do need to be careful about here is a lot of companies will have combined on their income statement depreciation and amortization. So obviously that includes both depreciation and intangible amortization. That is relevant, right? Because you do need to break down the components of that. Because both depreciation and amortization are natural expense categories that have to be broken down. So that needs to be considered. And I think that's pretty common in practice. You often see occupancy and equipment, depreciation and amortization, or other kind of bundled line items there. So when you have those bundled line items, it's likely there's going to be underlying natural categories within those line items.
Yeah. And I guess also we need to hit on kind of the practical expedients that offer some relief. There's two of them. So the first one is for purchases of inventory. So if substantially all of an expense caption comprises of purchases of inventory, so this can be the substantially all is generally interpreted as 90% or more. You do not have to disaggregate it. So you can provide a qualitative description of what's in the caption. So if you have an expense caption, that's 95% purchases of inventory and then 5% of other stuff. You can elect this practical expedient, and this would be relevant for industries that present expense captions like purchases or cost of materials that are primarily inventory purchases. So if you think of like your retail, distribution, and then maybe certain wholesale businesses. Although companies still need to assess whether there are other costs mixed in that would bring them below that 90% threshold. The second practical expedient is specifically for banks and entities that present salaries and employee benefits on their income statement per Regulation SX Rule 904. If you are subject to that rule, you can use those amounts rather than applying the DISE definition of employee compensation, which avoids having to do a completely separate calculation. But it's a narrow expedient. It only applies if you are subject to Rule 904. You can't apply it by analogy if you're a non-bank with a similar line item, obviously. So
special rules for the banks, right? All right, well, let's maybe talk through some examples to help verbally illustrate. Is that a thing?
to the best.
Yeah, to help maybe just clarify just how some of this would work in practice at a very kind of simplistic level. So we could take a manufacturing company, maybe as example one, that has traditional income statement, right? So think of things like cost of goods sold, SG&A, maybe some research and development, interest expense, income tax expense. Starting with the first one, cost of goods sold. Obviously, this is definitely going to be a relevant expense caption because it's going to likely contain multiple natural expense categories, right? So purchases of inventory, since it's a manufacturing company, it's probably going to have employee compensation as it relates to employee costs for those production workers. Depreciation is likely embedded in there as well, right? If you think about all the equipment and the depreciation of that equipment to create that inventory and sell that inventory, and maybe even some amortization if you have any patents or other technology that's used as part of the manufacturing process. So that one obviously is going to have to be disaggregated under DISE. Moving down the income statement, SG&A is next. Almost certainly this one's also going to be relevant, right? Because you've probably got employee compensation related to non-production workers, so corporate staff and the like, depreciation and all your other kind of fixed assets, so office equipment, buildings, etc., and maybe even some other intangible amortization, depending on if you've got relationships, trade names, whatever other common intangibles might exist in a manufacturing company. R&D could also be relevant because it's likely also going to be made up one of those 5 natural expense categories. So it could be compensation related to some of that research and development that gets allocated there, depreciation on any equipment that's used as part of the research and development process. And like I said, also amortization related to maybe some acquired technology that's used in the creation of R&D. Interest expense and income tax expense, I think we kind of hit on this a little bit earlier, but those are likely not going to be relevant because if you think through those kind of 5 natural expense categories, you don't typically see any of those rolling up under interest expense or income tax expense. So you would ignore those for purposes of the DISE disclosure. So at the end of the day, you're basically going to be disaggregating 3 different relevant expense captions: cost of goods sold, SG&A, and R&D.
Okay, let's talk through another example. So if you're a service company that actually doesn't have inventory,
okay,
you would likely have cost of services or cost of revenue on your income statement. That would likely be relevant because it contains employee compensation for the people delivering services, which for a lot of businesses is the biggest cost component. You might also have depreciation if you have equipment used to deliver those services, or intangible amortization if you have customer relationships or contracts. SG&A would still be relevant for the same reasons: employee compensation, depreciation, amortization. So even without inventory, you still have relevant expense captions because of the other natural expense categories. That's an important point because purchases of inventories is just one of the 5 categories. So even if you don't have inventory, you probably have some employee compensation and depreciation at a minimum. There are very few businesses that wouldn't have at least one of these 5 categories somewhere in their expense structure.
Yeah. All right. Well, hopefully those examples were helpful. So I think that is a good place maybe to kind of wrap up episode 1. I know we'll dive deeper in as we kind of work our way through the series here, but wanted to at least help set the foundation. And maybe before we close, we kind of highlight some key takeaways from today's episode.
Sure.
Awesome. All right. So takeaway 1 that I have here is, I think this is important for our listeners to understand, is this is a significant change, right, to financial reporting for public companies. Even though we are just talking about a disclosure, right? It's not necessarily changing anything on the face of the financial statements. Companies are going to have to fundamentally change how they communicate about different cost structures. And it's going to require, some preparation, frankly. Takeaway 2 is kind of the who and when this applies to, right? So we mentioned that it applies to public business entities. I think the other thing people need to recognize is, though, even though the standard is a couple years out from its effective date, right? So it's for fiscal years beginning after December 15th, 2026 for annual reporting. And then the subsequent year, December 15th, 2027 for interim reporting. Most companies are going to have to get ahead of it. You can early adopt if you want to. It is permitted, but I think a lot of companies are going to wait just because of the heavy lift that has to go into getting ready for the standard. And then the third takeaway, I think, is just kind of recapping, hey, what are the core requirements of this standard? So you have to disaggregate those relevant expense captions, which are those income statement line items within continuing operations that contain any of those 5 natural expense categories. So purchases of inventory, employee compensation, depreciation, amortization, and DD&A, and you have to provide that disclosure in a tabular footnote in the financial statements.
There are also some important exceptions to remember.
Yep.
So equity method investments are not subject to this, and expense captions that consist entirely of one natural category don't need further disaggregation. There are 2 practical expedients, one for when substantially all of an expense caption is purchases of inventory, and one for banks presenting salaries and employee benefits under SX Rule 904. Companies also have to separately disclose total selling expenses, which is a management-defined measure, and all of this applies to both annual and interim periods. Okay, so where are we headed next? In episode 2, we're going to deep dive into each of the 5 natural expense categories. So if we haven't said it enough, we're going to say it again. What's included in purchases of inventory? How do you define employee compensation? What qualifies as depreciation versus intangible amortization? We're also going to tackle complex areas like the cost incurred versus expense incurred basis for inventory, how to handle intercompany transactions, what to do with standard costing variances, how to finance lease ROU assets and leasehold improvements get classified. These are all the questions we are already getting from clients, and so we want to make sure everyone has a clear roadmap.
And then the final episode in our 3-part series will focus on practical implementation guidance. So we'll cover things about kind of like what systems and process changes are necessary, even common challenges that we're seeing or hearing about that clients are facing in different industries. What are some of the emerging best practices as people are kind of starting kind of their implementation journey on DISE. We'll also cover things about how this standard, might interact with other standards under US GAAP. So like segment reporting, for example, or even some of the industry specific considerations. So definitely stay tuned for those next 2 episodes as we kind of unpack the standard a bit further. So perfect. So I think that brings us to the end of episode 1 of our DISE series. Thanks, Nicole, for always providing your perspectives and insights. And thanks to our listeners for joining us on this episode of Accounting Matters. Definitely stay tuned for parts 2 and part 3. And in the interim, if you want to connect with either of us, join us on LinkedIn. We'd be happy to carry on the conversation. And we'll see you next time on Accounting Matters.